Hi, I'm Jenny Brown. Welcome to our weekly buy-to-let mortgage market update. I hope you're all keeping incredibly well, that you had a fantastic bank holiday weekend. How about that weather, eh? Can't believe it. So lovely to have a bank holiday in the UK with the sun shining. I think a lot of you are actually away as well for half-term weeks, or whatever you're up to. I hope you're having a really amazing time. So look, we have got so much to cover off for you this week. It's been a 4-day working week, and yet the lenders have been in absolute overdrive with changes with regards to both pricing criteria, and also we've had some new products come to market. So loads of great stuff to run through with you today. Okay, so first up this week, we have got lots of exciting news from Paragon, who are clearly on a bit of a mission to shake things up at their end and bring some new products to market, which is great. So first of all, what Paragon have done is re-entered the short-term lending space, as we would call it, bridging finance. And what they've done is bought out some really competitively priced products with rates starting from 0.45% per month. Now, the way the pricing works is there are really two things which influence the pricing that you can access. The first thing is the loan to value. So obviously at 50% loan to value, you're going to get much better pricing than if you're borrowing at 75% loan to value. But the other thing is the scale of the works that you're going to do. So they have standard refurbishment, bridging finance or short-term lending, light refurbishment, and then heavy refurbishment. So if the scale of the works is much more aggressive, you're looking at heavy refurb, that's going to cost you more than if you're doing a very light refurbishment, essentially. Now, the products that they've brought out, like I say, they're very competitive. They brought something out which is quite unique. They've got a set of rates which actually are higher on interest, but actually have no arrangement fee. They also have rates which are lower on interest, but have an arrangement fee as well. Now, the reason this is relevant is because for people who are looking to take out short-term finance, but are only going to need it for a very short period of time, if you're looking at paying an arrangement fee, and the standard arrangement fee in the bridging finance world is 2% of the loan, but you're only going to have the loan for 2% compounded, that actually makes the cost of borrowing really expensive. Whereas obviously if you're going to have the loan in place for 12 months, it could be that paying the arrangement fee to buy that better interest rate works out well for you. So it really does depend on the numbers, but it's really great they've actually brought out an option with a no arrangement fee offering to our clients, which is fantastic. Now, in terms of their offering, the other thing that they're doing, which I really like, is offering the ability to pre-underwrite a buy-to-let mortgage application at the same time. So essentially your bridging loan exit. So what this would mean is that you would apply for the bridging loan at the same time you're applying for a buy-to-let mortgage. The underwriter is going to underwrite both applications simultaneously, and then once you've finished the works of the property, you can exit seamlessly onto the buy-to-let mortgage. And our clients really like this, because I think one of the biggest concerns when you're taking a bridging finance is, what if I can't exit the loan? What if I'm stuck on these really high interest rates for the duration? It's going to be really bad for me. So the fact you can get a mortgage agreed up front, a mortgage offer accessed straight away is really fantastic. Now, in terms of the kind of risks with this, I think it's fair to say that the real risk would come in if you applied for a bridging loan or short-term finance with Paragon, said that you were going to be doing a light refurbishment, so just new kitchen and bathroom, and then ultimately you demolished the property and rebuilt it, so you didn't stick to what was the original plan. Obviously then, they're going to come to do the exit and say, well, hang on, this is, totally different to what we agreed up front, so we're not going to lend on this. So as long as you make good on the arrangements that you agreed up front with the lender, then you should have no problems obtaining the exit. So like I say, it's a really competitive offering. Precise Mortgages offer something very similar to this, actually, their refurb to let product, which is very popular. The difference with the Paragon offering is that they are actually offering a high loan to value on the bridging finance part of the loan, which obviously will make that more interesting to some of our borrowers. Now, Paragon have also in the last week re-entered the holiday let market, which is fantastic, and they're now offering loans for purchases and remortgages, personal or limited company, loans of up to £500,000 at 70% loan to value. Now, in terms of their pricing, it's not bad at all. What I think I really like about the Paragon holiday let offering is the way that they're assessing affordability. So if you are watching these videos frequently, you will know that a lot of the lenders in the buy-to-let space are assessing affordability based on a notional AST rental income, rather than the what would generally be higher holiday letting income the property would achieve. And the reason that they do this is really to safeguard themselves and the borrower in case the borrower goes into holiday letting, realises that it's just really not for them and defaults to letting on an AST. Also, it comes back to also managing the property if they had to repossess it as well. Lenders don't want to be in the business of letting holiday lets. They can just about manage running a normal buy-to-let property. But Paragon are taking the view that they will use either the AST rental income, or where you can evidence 2 years holiday rental income, they can use this instead. So that can work out really, really well for those people who are either remortgaging or those people who are looking to buy what is an established holiday letting property. Like I say, the rates are very, very good. Things I like about Paragon are that they are very, very landlord friendly. They don't mind how many properties you have in the background. They're able to consider older applicants. They do need you to be earning £25,000 a year. That's one thing just to note. But yeah, a really solid holiday let offering brought in by Paragon. Perfect timing, I would suggest, for those people who have been having a staycation in the UK over half-term week. Lastly, from Paragon, I did warn you that they've been busy. They have introduced some new rates and also made some reductions to pricing on existing products. So what does this look like? So they've included a reduction in their 5-year fixed rates for both single unit properties and also their HMO and multi-unit blocks. They've also introduced 2 new 5-year fixed rate products. Now these products are fixed for 5 years at 3.25%, and they have a fixed arrangement fee of £10,000, which sounds incredibly expensive, I know, unless you are looking to borrow a larger loan. So when you factor into the mix that Paragon are able to lend on multi-units of up to 20 units, HMOs of up to 20 bedrooms, and therefore they would potentially be able to access those larger properties which come with a higher value. They're actually allowing loans of up to £2 million, incidentally, and can go even higher than this by referral on an individual property. Actually, for those people who are looking to finance these larger HMOs, the arrangement fee being fixed at £10,000 is actually, can work out incredibly well for you, particularly when you factor into the equation that you're accessing a very, very good rate at 3.25%. So really good to see Paragon introducing something which is really aimed at those larger loan amounts. I think when we look in the specialist end of the market, when you're looking at lending to limited companies, or where you're looking at larger HMOs and multi-units where the loan amounts do tend to be bigger, for these borrowers, they do find the arrangement fees, when they're a percentage charge fee, particularly at 1.5–2%, they can find them quite eye-watering. So actually, while £10,000 may sound expensive, actually for a lot of these borrowers, these deals could work out incredibly well for you. The mortgage works have reduced some of their remortgage rates, and they now start from 1.19%. So the reductions have been by up to 0.4%, which is pretty impressive. Now, the mortgage works have a set of products which are available for landlords with portfolios of up to 10 properties, and then a very different set of products for landlords with properties of portfolios of more than 10 properties. So these particular rates that we're referring to here fall in with those landlords with the smaller portfolios. The mortgage works, they're a really great lender. They have been around in the market and been prolific lending in the buy-to-let space for as long as I've been in the industry, which is 17, 18 years now. They don't mind how much you earn as long as you earn something. If you apply for a mortgage with them before your 70th birthday, you can have up to a 25 or even 30-year term. They are good on certain unusual property constructions as well. So loads of great things going for them, and actually some really, really good remortgage products as well. Remortgaging is going to be the name of the game over the next few months. There's a whole bunch of people who took out mortgages on 5-year fixed rates 5 years ago in the run-up to the changes that were made to rental calculations when the PRA regulations kicked in. And so there's a whole swathe of remortgages which are coming up for renewal. And so, actually lenders looking to sort of sharpen their pencil, as it were, on their remortgage pricing is to be expected, as they're going to be really going in for a slice of that business. Now, conversely to this, the mortgage works have also made some changes to their limited company rates, and these have gone up. And they're not the only lender we're going to talk about this week who've actually pushed their pricing up rather than down. It's quite unusual at the moment. I find myself constantly referring to pricing coming down. And there is still a lot of that going on. But it's interesting that we're starting to see some lenders pushing their pricing up again. I suspect with the mortgage works, what's happened here is that their limited company rates are, they're very good. Not the best in the market, but very, very good. And I think sort of they're a lender which is very known to the more kind of residential brokerage. And so these guys will be getting absolutely flooded with business. So I imagine what they've done is they've just pushed their pricing up to try and stave things off. But their limited company pricing is still very good. The rates start from 3.09%. What they're looking for in terms of limited company borrowing, they're looking for very, very straightforward cases. So they really don't want anything more than two people named on the application. So within the company structure, you can only have 2 directors who can also only be the shareholders. You can't have anybody else. But other than that, the approach to their lending policy is very similar to their residential. They're able to consider some unusual property types. It's very, very good, no minimum income requirement, and can consider older applicants as well. So, interesting to see what happens there. We'll keep our eyes peeled on the pricing in the limited company market. But as you're going to see from the other updates I'm going to give you today, the general trend is still very much downwards. LendInvest have made some changes to their pricing and criteria, all favourable, I should add. So first of all, what they have done is changed the rental calculation they're using on some of their products. So essentially, what they were doing before was on 5-year fixed rate, saying the rental calculation would be 125% or 145% coverage, assuming a notional rate of 5%. Now what they're saying is actually the rental calculation is 125% coverage or 145% coverage, assuming a rate of 3.39%. And what this means for you as a borrower is essentially you can borrow more per pound of rental income than you could previously. Why have LendInvest done this? I suspect what they've done is they've looked at their offering, realised that actually a lot of their competition were using that more generous rental calculations. They've just adjusted things to really align themselves with the rest of the market. Now, they've also made some rate reductions across their range. Most notably, they have dropped down their 5-year fixed rate product for small HMOs, that's up to 6 rooms, by 31 basis points, and made some other tweaks across their range downwards in terms of the pricing. So really, really good. LendInvest are able to lend to individuals and limited companies. They don't mind how many properties you've got in the background, and they're a really, really good lender to deal with. Actually, we do rate them. They're leaning quite heavily on technology, which does help to speed things up. And obviously at the moment, I think a lot of people are very focused on service and quick turnaround times. So LendInvest are a good fit for you there. Fleet Mortgages have been busily assessing their lending policy and have made some rather nice changes to their lending criteria. So first of all, what they're now saying is that they're happy to lend to LLPs, limited liability partnerships. People borrowing via an LLP will be able to access their limited company products. Now, they've also looked at their appetite to lend and what they require, where there is a connection between a leasehold borrower where they also have an interest or a control over the freehold. So in this situation, if you imagine that there is a block of flats, I have a leasehold flat within that block and I also own the freehold. That would be a very simple example. So what Fleet traditionally were doing is saying that they were happy to lend, but they would require a charge over the freehold. They are no longer asking for a charge over the freehold. Now, in terms of why a lender would want to have that charge on the freehold and how common that is, actually it's not unusual for a lender to request a charge on the freehold, although not all lenders do this. And the reason for this is, if you imagine that I took a mortgage out with Fleet on my leasehold flat, and then I didn't pay my mortgage and they wanted to repossess me, because I can control the freehold, I can make access in terms of repossession very, very difficult. I can start doing things with regards to the ground rent and service charges to make the property unsaleable. So essentially I can just make the lender's life very, very difficult in event of a repossession. So the reason some lenders like to take a charge over the freehold is it just means that if in the event of repossession, they can then take control of that and make sure that there's no kind of difficulties when it comes to resale. But obviously Fleet have had a look at their policy and decided that actually it doesn't really bring any value to them, and they're not going to be asking for that anymore. Now, they're also saying that they're reducing their minimum size on studio flats down from 35 square metres to 30 square metres, which is really good. 30 square metres is not unheard of in the market. You will find that most lenders, anything under 30 square metres, they will duck out. But it's great to see that they've reduced that down as well. Now, the other thing that they've introduced, which I think is quite neat, is they're now happy to lend on blocks of 4 flats if each one's on a leasehold. So if you imagine there's a block of 4 flats, each flat is on a leasehold, and I would control the freehold probably in that situation. But essentially what Fleet are saying is actually if there's 4 flats, we can lend on every single one. We're quite happy with that. Most lenders have what they call an exposure limit within a development. So previously Fleet would have been saying would lend on sort of circa 20-25% of the number of flats, which in the situation of 4 flats would have been just 1. But now they're saying they can lend on all 4. What they are also saying is if there are 5 flats or more, they are capping their exposure to 2 or 20% of the building. So if you are in that situation where you've bought a house, this is the very sort of standard example where you would see this, you've bought a house, you split it into 4 flats, they're all on long leases and you're looking to refinance, Fleet could be a very, very good lender for you to approach. Okay, some other movement in the market to note, and I'll go through these relatively quickly. We have seen some very slight reductions on pricing from platform home loans. We've seen reductions of up to 0.1% and also increases of 0.01% across their range. So essentially they've just been tinkering with their offering and adjusting some costings there. We've also seen Virgin reduce some rates by 0.02% and some by 0.05%, so some very minor pricing adjustments. We have seen the Leads reduce some of their rates by 0.05%. Conversely, we have seen the Principality increase selected buy-to-let and holiday-let rates by 12 basis points, and the Skipton have also increased the majority of their buy-to-let rates by up to 16 basis points. Now, in terms of what's going on here in the market, I think really it's just lenders looking at business flows, cost of funds, that kind of stuff, and just and making slight amendments to their pricing to ensure that the numbers are kind of working out at their end. Like I mentioned earlier on, there has been some increases in pricing in the market, and I suppose it stands out because we just haven't really seen much of that recently. But actually the pricing increases that we're seeing, I suspect, is largely down to managing business volumes, particularly when we referred to the Mortgage Works earlier. And with these guys, I think it's more just about looking at, making sure that the numbers are working out across their product set and them being commercial. In terms of those lenders, these are all lenders who are playing very much in the vanilla end of the market, so lending to individuals, those people with the portfolios of, and depending on the lender, but 10 or less really speaking, but the pricing is very, very good in that space. If I were you and I was thinking about taking a remortgage, at the moment, I'd be really thinking about doing it now. The pricing is just so good at the moment. So yeah, if you are thinking about a remortgage, if your rates are coming up for renewal, particularly around October time, we're seeing a lot of people with rates ending then, do give us a shout because the pricing is really good. Okay, I just want to wrap things up this week by talking to you a bit more about the housing market. Now, you will have probably seen the headline which was reported in the last couple of days, where the Nationwide have released their latest house price index and noted that the annual house price growth is now up to 10.9%, which is the highest level recorded since August 2014. Now, I think the reason this is really relevant to you as property investors is I know that when we're speaking to our clients, there are really 2 things that are on their mind in terms of buying property. And the first one is that they are saying that actually there just isn't a lot of stock out there at the moment, and we'll come on to that further in a few moments. But the other thing they're saying is actually at the moment, the stamp duty holiday is driving things crazy. They're just going to sit back, let the stamp duty holiday end, let the market cool off, and then come in and hopefully get some, better prices on new acquisitions. So the reason I wanted to comment on this is actually that the chief economist of the Nationwide, a chap called Robert Gardner, has commented on this, and I think it's just worth noting or talking about this a bit further. So what Robert Gardner has said is that the market has seen a complete turnaround over the past 12 months. So a year ago, activity collapsed in the wake of the first lockdown, with housing transactions falling to a record low of 42,000 in April 2020. But activity surged towards the end of the year and into 2021, recording a record high of 183,000 transactions in March. Now, what he said is that while March's spike in transactions was driven by the original end date of the stamp duty holiday, a lot of momentum has been maintained. Now, their research indicates that the extension to the stamp duty holiday is not the key factor, although it's clearly impacting the timing of transactions. So amongst homeowners surveyed at the end of April that were either moving home or considering a move, 3/4, 68%, said this would have been the case even if the stamp duty holiday had not been extended. It's the shifting housing preferences which is continuing to drive activity, with people reassessing their needs in the wake of the pandemic. So essentially what we're saying here is that actually, yeah, of course, the stamp duty holiday has been a nice thing for people to have. It's certainly helped out, particularly at the sort of starter end of the market, the first-time buyers. But fundamentally over the last year, where we've all spent, huge amounts of time in our own homes, people are really just reassessing where they want to live, and they would be moving anyway, irrespective of the stamp duty holiday. People are just looking to try and push forward or bring forward their completion dates to try and save the stamp duty money, but it's not the driving factor in why they're deciding to move. Now, just coming on to the point we made earlier on about the lack of stock in the market, and I think this is probably more the issue for our landlords just now. The Property Mark have released some information, which is that there are just 27 properties per estate agent branch available in April 2020, which is down from 31 per branch in March. This is nearly the lowest number seen since December 2002, when there were just 25 available properties per branch. So essentially what we can see here is that fundamentally there just isn't very much stock available at the moment. So obviously when things do come to the market, there's a lot of competition to access those properties. The number of properties which are selling over asking price is also at a really, a high at the moment as well. And that really is driving up the house prices. So I think really in terms of if you're looking to invest, what are you waiting for to see house prices soften? And what you really do need to see is more properties coming to the market and less people looking to buy those. But until there's a real surge of properties coming for sale, I don't actually think you're going to see that happen. So I think if you are, as in summary, thinking about acquiring a property over the coming months, I'm not convinced, and I have been saying this for a while now, I'm not convinced that just holding on and waiting for the stamp duty holiday is actually going to benefit you. I actually think, now it is really just as good a time as ever. House rental yields are on the increase, so in terms of the numbers, actually things will balance out. I think your biggest challenge is really just actually accessing a property at all in the first place. So there you go, not even a bank holiday and therefore a 4-day working week can slow down the pace of change in the mortgage market at the moment. I hope you found that really helpful. And as always, if you do have any questions, please do get in touch. We would absolutely love to hear from you. 0345 345 6788, or have a look on our website. So look, until next week, please do enjoy the weather. It's absolutely glorious again today. I'm looking forward to watching it through my office window. But for those of you who aren't working, I hope you're going to have a really, really great few days in the sunshine. I will catch you next time. Until then, look after yourselves.